Ecolab, ticker ECL, on the NYSE. Founded in 1923 in St. Paul, Minnesota by Merritt Osborne as Economics Laboratory, Ecolab began as a dishwashing compound company and spent 100 years expanding into the world's leading water, hygiene, and infection prevention solutions company.
Today, Ecolab sends more than 30,000 field sales and service representatives to customer sites in 170 countries every week. That embedded service model is the moat. Commodity chemical suppliers cannot replicate the operational integration that weekly technician visits create.
The company renamed itself Ecolab in 1986. The 2011 Nalco acquisition for $5.4 billion transformed it into the world's largest industrial water treatment company. The 2022 Purolite acquisition for $3.7 billion added life sciences water purification resins.
In 2025, Ecolab announced a $4.75 billion data center cooling services acquisition, positioning itself at the center of AI infrastructure's most critical operational challenge: managing the heat generated by hyperscale GPU compute at scale.
The business segments across four pillars: global industrial at 42% of revenue, global institutional and specialty at 35%, global healthcare and life sciences at 14%, and other at 9%. Total revenue is $16 billion.
Gross margin is 42.8%. EBITDA margin is 20.2%. Return on invested capital runs at 15.8%. Ecolab has raised its dividend for 32 consecutive years, the kind of track record that defines a compounding business.
Four regulatory compliance verticals converge on Ecolab's expertise: food processing sanitation, healthcare infection prevention, hospitality kitchen standards, and industrial water discharge regulations. Compliance expertise makes Ecolab the lowest risk vendor choice in each category.
The AI tailwind is real and specific. Hyperscale AI compute generates 10 to 50 times more heat per square foot than traditional server infrastructure. Ecolab's water treatment expertise positions it as the preferred cooling water chemistry provider as data centers scale globally.
On the competitive radar, Ecolab scores 95 on service network and 92 on water treatment scale, both the highest among peers. Its AI data center exposure score of 88 reflects the unique positioning the Nalco and cooling acquisitions have created.
Veolia Environment is the closest water treatment peer globally. Pentair and Xylem compete in water technology, but lack the field service density and customer site integration that define Ecolab's model in food, healthcare, and hospitality verticals.
Ecolab serves 3 million customer locations: restaurants, hospitals, hotels, food processing plants, pharmaceutical facilities, power stations, and now data centers. Each location with a weekly Ecolab service technician is a sticky, recurring revenue account.
Christoph Beck became chairman and CEO in 2021, succeeding Doug Baker after a decade of McKinsey, then Ecolab ascending through Nalco Water Leadership, Global Regions, and COO. His ETH Zurich chemical engineering and INSEAD MBA background are perfect for this chemistry and service business.
Under Beck, the margin expansion story has accelerated. EBITDA margins improved 1.1 percentage points year over year, as pricing power and the higher margin institutional and industrial mix shifts have compounded on top of one another.
Ecolab has made every surface cleaner and every gallon of water work harder for 100 years, and now the AI infrastructure build-out has made industrial water treatment the most relevant thing it has ever done.
The data center cooling acquisition is the key inflection to track. If AI cooling water chemistry becomes a major revenue line by 2027, the business has found its next decade of growth catalyst. We dig into the numbers every quarter. Subscribe so you never miss a Charged Alpha deep dive.
Ecolab just posted a quarter that makes the AI data center thesis concrete. EPS of $1.95 against a $1.79 estimate, an 8.9% beat, with AI cooling water treatment revenues from Nalco Water pacing over $350 million annualized and growing at over 80% year over year. We're breaking it all down today.
Ecolab traces its roots to St. Paul, Minnesota, 1923, a company that started by solving restaurant dishwashing and spent a century quietly becoming indispensable to food processing lines, hospital surfaces, hotel kitchens, power plants, and now AI data center cooling systems across 170 countries.
And today's episode is about the question that defines ECL's next chapter. Can the AI infrastructure supercycle turn Nalco Water, the world's largest industrial water treatment company, into a billion-dollar growth engine within 3 years? The Q1 numbers are the first hard evidence that the answer might be yes.
Here are the Q1 2026 headline numbers. Revenue of $4.25 billion against the $4.08 billion estimate, a 4.2% beat. Adjusted EPS of $1.95 against $1.79, an 8.9% upside surprise. Both lines beat cleanly, and the stock added 2.8% on the session.
The EPS beat came from a combination of gross margin expansion and revenue upside. Gross margin reached 43.8%, up from 42.5% in Q1 2025, a 130 basis point improvement. When you're running $4.25 billion in quarterly revenue, that margin expansion translates to roughly $55 million in incremental profit.
The segment that matters most right now is Global Industrial, which contains Nalco Water, the industrial water treatment business. This segment is where the AI data center cooling revenues sit, and it grew organic revenue by 6.8% year over year in Q1, the fastest organic growth rate in 3 years, driven specifically by hyperscale data center demand.
The gross margin expansion story at ECL is about two things working simultaneously. First, product mix is improving. AI data center chemistry commands higher margins than commodity industrial cleaning products. Second, digital delivery tools are reducing the cost per service call as field technicians handle more sites per route. Both tailwinds are structural, not cyclical.
Global Institutional and Specialty, the hotels, restaurants, food service, and laundry segment, showed organic revenue growth of 3.2% year over year. Hotel occupancy rates normalizing post-2024 softness and food service volumes recovering from the consumer spending caution are both driving volume recovery. This segment is the stable recurring cash flow base.
Global healthcare and life sciences, infection prevention for hospitals, and water purification chemistry for pharmaceutical manufacturing delivered organic growth of 4.5%, with life sciences particularly strong. The Purolite resin business, which serves pharmaceutical water purification, continues to benefit from nearshoring of drug manufacturing in North America and Europe.
Operating income came in at $646 million for Q1, representing a 15.2% operating margin, up from 14.1% in Q1 2025. The 110 basis point improvement in operating margin reflects the combination of gross margin expansion and disciplined SG&A management. Christoph Beck has been explicit about the margin expansion roadmap through 2028.
SG&A came in at 22.4% of revenue, down from 23.1% in the prior year quarter. Ecolab is investing in digital route optimization and customer-facing technology that lets field representatives service more sites per day, which means the labor cost per customer site is declining even as service quality improves. This is real operational leverage, not accounting.
Net income of $501 million for the quarter, adjusted EPS of $1.95 diluted over approximately 283 million shares. The share count has been declining through buybacks, down about 2% from the year-ago level, contributing roughly 4 cents per share of annualized EPS tailwind, independent of earnings growth.
Cash flow, operating cash flow of $700 million for the quarter, capital expenditures of $250 million, yielding free cash flow of $450 million. Q1 is seasonally the weakest cash generation quarter for Ecolab, given institutional customer payment timing. The full-year FCF trajectory is approximately $2 billion.
Balance sheet, net debt of approximately $7.8 billion, with net debt to EBITDA at 2.2 times, down from 2.5 at the end of FY 2024. Ecolab is generating approximately $2 billion in annual free cash flow against this debt load, implying full paydown of 1 EBIT turn of leverage within roughly 18 months. Below 2 times, a buyback expansion authorization becomes the expected next step.
FY 2026 guidance. Management provided adjusted EPS of 835 to 865, midpoint 850, implying approximately 16% growth over FY 2025. Revenue guidance of 17.2 to 17.7 billion, gross margin above 44% for the full year. And critically, AI data center water treatment revenues are pacing over 350 million annualized, on track for 500 million by year-end.
Let's go deep on the AI data center opportunity, because this is the catalyst that separates ECL from every other specialty chemical company. Hyperscale AI compute generates 10 to 50 times more heat per square foot than traditional server infrastructure. That heat is removed through water cooling systems, either liquid cooling loops or cooling tower water, and every gallon of cooling water requires precise chemical treatment to prevent corrosion, biological growth, and mineral scaling.
Nalco Water provides the chemistry, dosing equipment, and field service technicians that keep those cooling water systems running. Each new hyperscale AI data center campus, a facility that might cost $3 to $5 billion in construction, requires approximately $2 to $5 million annually in Nalco Water chemistry and service. With over 200 large-scale AI data centers in the global development pipeline, the addressable revenue opportunity is measurable and growing.
Christoph Beck, on the Q1 earnings call, specifically quantified the data center pipeline as the fastest-growing vertical in Ecolab's history. He noted that every major hyperscaler, the largest cloud and AI infrastructure operators, is either an existing Nalco Water customer or in active procurement discussions. The switching cost once Nalco Water chemistry is specified into a facility's cooling design is effectively prohibitive.
The 3 million customer sites that Ecolab serves globally are protected by a structural moat: replacement risk. A food processing plant cannot risk a product recall by switching cleaning chemistry mid-cycle. A hospital cannot introduce an untested disinfectant on active patient care surfaces. A data center cannot risk cooling system failure to save on water treatment chemistry cost. In each case, the cost of failure far exceeds the cost of switching vendors.
The service model compounds the moat. Ecolab's field technicians visit customer sites on a scheduled basis, weekly for many accounts, not just to apply chemicals but to monitor system performance and compliance documentation. This embedded service relationship makes Ecolab functionally an outsourced part of the customer's operations team, not a product vendor. That's why renewal rates exceed 90% across all verticals.
Water scarcity is an underappreciated long-term tailwind for ECL. Global freshwater stress is intensifying across every major industrial region, making water efficiency and treatment a non-discretionary operational expense. Ecolab's technology saves over 210 billion gallons of water annually for its customers. That's a measurable ROI that customers can calculate against the cost of the service contract.
International performance in Q1 was notably balanced. Asia-Pacific delivered 6.2% organic growth, driven by food safety regulatory compliance investment in China, India, and Southeast Asia. Europe grew 4.1% organically despite the broader European manufacturing slowdown, reflecting the defensive nature of the food safety and hygiene verticals even in a macro-challenged environment.
Let's talk valuation. At $258, ECL trades at 30 times the forward EPS projection of $850 for FY 2026. The 10-year historical average forward multiple for ECL is approximately 35 times. At 30 times, you're buying the world's leading water treatment and hygiene franchise at a 5-turn discount to its historical average, and with an AI growth catalyst that didn't exist when the multiple averaged 35.
Why has the multiple compressed from 35 to 30? 2 reasons. First, the post-Nalco and post-Purolite debt load. At 2.2 times net debt to EBITDA, ECL is more levered than the market prefers for a premium multiple compounder. Second, institutional end market softness in 2024 compressed near-term EPS expectations. Both are transitional constraints, not structural changes to the business.
Analyst Consensus, 20 analysts covering ECL, consensus price target of $280, representing 8.5% upside from current levels. 12 buys, 7 holds, 1 sell. The high target of $320 implies 24% upside, the bull case if AI data center revenues ramp faster than expected. The low target of 215 suggests modest downside even in a macro stress scenario.
Bull. AI data center cooling revenues scale to $1 billion by 2027. Gross margin crosses 45%. ECL re-rates to 35 times forward. That puts fair value above $350. Bear. AI capex slows, institutional end markets disappoint, net debt stays above 2 times, multiple stays at 25. That's approximately 212. The bull case magnitude significantly outweighs the bear case.
The single most important metric to track for ECL is the AI data center cooling revenue run rate. At $350 million annualized in Q1 2026 and growing at over 80% year over year, it's on track for $500 million by year-end. Each incremental $100 million in data center revenue adds roughly 15 cents to annual EPS. If it reaches $1 billion by 2027, the EPS accretion is transformative.
Why does the data center revenue run rate matter more than any other metric? Because it's the signal that ECL's existing Nalco water infrastructure is capturing the AI supercycle without material incremental capital investment. The chemistry knowledge, delivery equipment, and field service network already exist. The data center revenue is incremental margin at above company average profitability. It's the definition of operating leverage.
Options activity heading into Q1 results showed call positioning, specifically June 265 calls with approximately 600 contracts. That represents conviction that ECL reaches 265 by June expiration. Implied volatility at 20% is below the specialty chemicals peer group average, consistent with ECL's reputation as a low volatility quality compounder with defensive end market exposure.
On insider activity, no open market purchases or sales post-earnings. CEO Christoph Beck holds shares from restricted stock unit grants. Vanguard, BlackRock, and T. Rowe Price together represent over 24% of shares. Institutional ownership at 84% is among the highest in specialty chemicals, reflecting ECL's position as a core quality growth allocation in institutional portfolios.
Beck has moved decisively since taking the CEO role in 2021. His priorities have been digital transformation of the field service model, operational margin expansion, and capital allocation discipline. The 43.8% gross margin in Q1 represents a 250 basis point improvement from the 2021 level. That's 5 years of consistent operational improvement.
Catalyst 1. AI data center cooling revenue acceleration. With over 200 major AI data center projects in the global pipeline, Nalco Water's first-mover position as the established provider to existing hyperscaler relationships gives it a significant head start. Each new facility represents a multi-year recurring revenue contract, not a one-time product sale. The recurring model is the compounding engine.
Catalyst 2. Institutional end market recovery. Hotel occupancy rates are normalizing toward pre-pandemic levels in North America and Europe, and food service volumes are recovering as consumer spending on dining stabilizes. This drives same-site volume growth in the global institutional segment, ECL's largest external volume indicator, at 3 to 4% organically, adding direct revenue without additional selling cost.
Catalyst 3. Gross margin crossing 45%. At 43.8% in Q1 with full-year guidance above 44%, ECL is within 12 to 18 months of the 45% threshold. Every 100 basis points of gross margin expansion at Ecolab's revenue scale equals approximately $170 million of incremental annual profit, or roughly 25 cents of EPS at the current share count.
Catalyst 4. Balance sheet deleverage, enabling capital return expansion. At 2.2 times net debt to EBITDA with $2 billion in annual free cash flow, ECL can reduce leverage to below 2 times within approximately 18 months while maintaining the current buyback pace. Below 2 times, history suggests a formal buyback program expansion. That's the capital return catalyst that institutional holders are watching for.
Risk 1. AI capex slowdown. If major hyperscalers reduce or delay data center construction spend due to demand uncertainty, tariff impacts on hardware, or regulatory constraints, the data center cooling revenue ramp slows materially. At $350 million annualized, This business is still small enough that a slowdown would be a headwind to the EPS growth trajectory, though not catastrophic relative to the base business.
Risk 2. Raw material cost pressures. Ecolab's specialty chemical formulations use surfactants, biocides, corrosion inhibitors, and polymers sourced from petrochemical and specialty chemical suppliers. Tariff escalation on imported chemical intermediates, particularly those sourced from China and Europe, could pressure gross margins if cost increases cannot be fully passed through in a softening institutional end market environment.
Risk 3. Rivals are targeting the AI data center opportunity. Pentair and Xylem, ECL's primary rivals in industrial water treatment, have both announced AI data center water management initiatives, and BASF and Dow Chemical are increasing investment in cooling water chemistry. ECL's installed base and existing hyperscaler relationships are strong advantages, but rivals are mobilizing capital toward this market.
But the competitive moat analysis matters here. When a hyperscaler specifies a cooling water chemistry vendor into a $5 billion facility design, that specification is locked in for the life of the facility, typically 15 to 20 years. Nalco Water's first-mover position in early hyperscale data center relationships means those contracts are won, and the switching cost going forward is existential. You don't risk a billion-dollar data center for a cheaper biocide.
The global service network reinforces the data center advantage specifically. Nalco Water can place a service technician at any hyperscaler campus globally within 24 to 48 hours, a capability that smaller rivals simply cannot match. When a cooling water chemistry issue arises in a Singapore or Frankfurt data center, you need a technician on site, not a phone call. That response capability is built over decades, not purchased.
The regulatory compliance moat is worth underscoring. Food processing plants face FDA and USDA compliance requirements for cleaning chemistry. Hospitals face Joint Commission infection control standards. Pharmaceutical water purification systems face FDA validation requirements. Each vertical requires not just the chemistry, but the compliance documentation, validation support, and regulatory expertise that only scale players like ECL can provide efficiently.
On capital return, the dividend yields approximately 1.1% at current price, with 33 consecutive years of annual increases. The payout ratio is 34%, well below the 50% ceiling that the board has historically targeted, leaving room for continued increases even in a flat earnings environment. The buyback yield of roughly 1.6% adds to total shareholder return.
The total return framework for ECL at current prices, 1.1% dividend yield, 1.6% from buybacks, and an expected 12% annual EPS growth rate, puts the base case total annual return at 14 to 15% before any multiple expansion from the 30 times current level, reverting toward the 35 times historical average.
Water scarcity deserves more weight in the long-term thesis. By 2030, the World Bank projects global water demand will exceed sustainable supply by 40%. Industrial companies that reduce water consumption, which Ecolab's chemistry enables, will face compulsory regulatory requirements in water-stressed markets. That turns Ecolab from a service vendor into a regulatory compliance requirement, raising the switching cost permanently.
The food safety megatrend compounds the institutional moat. Global food supply chains are under increasing regulatory scrutiny across every major market, from the FDA's new era of smarter food safety framework to the EU's farm-to-fork strategy. Each regulatory tightening increases the compliance value of Ecolab's documentation services, making the service contract a regulatory risk management tool, not just a cleaning chemical purchase.
The life sciences water purification opportunity through Purolite is an underappreciated growth driver. Pharmaceutical manufacturing requires ultra-pure water for drug production, and nearshoring of manufacturing in North America and Europe is driving new facility construction that requires Purolite's ion exchange resin technology. Each new pharma facility is a 15 to 20-year Purolite customer relationship with high switching costs built into the facility validation process.
Return on invested capital at 15.8% is progressing toward the target. The Nalco and Purolite acquisitions added substantial goodwill that suppresses ROIC below the pre-acquisition level. As acquired revenue scales over the fixed goodwill base and operating margins expand towards 17%, ROIC should recover towards 17 to 18% by FY 2028, the level that fully justifies the 30 to 35 times forward multiple.
What does a buy look like for ECL at current levels? At 30 times forward earnings with a catalyst path toward 35 times as AI data center revenues ramp and gross margin expands, the math is $8.50 in FY 2026 EPS times 35 equals approximately $2.98. That's 15% from here in the base case, before dividends and buybacks. With 12% annual EPS growth underneath, the compounding is significant.
The three numbers to watch for Q2 2026. First, the AI data center revenue run rate needs to accelerate toward $400 million annualized to validate the $500 million year-end target. Second, gross margin needs to exceed 44% to prove the trajectory is intact. Third, global industrial organic revenue growth needs to stay above 5% to confirm the data center cycle is sustaining.
For Q2 2026 specifically, consensus models EPS of $2.18 versus $1.96 in Q2 2025, an 11% year-over-year growth expectation. Revenue consensus at approximately $4.4 billion. Q2 is seasonally stronger for ECL, given institutional customer seasonal patterns. Hotel occupancy peaks in summer, food processing runs at elevated capacity. The beat setup is favorable.
The AI infrastructure thesis for ECL is the cleanest version of the picks and shovels framing we've seen in the data center supercycle. You're not buying NVIDIA at 50 times earnings. You're buying the essential water treatment chemistry that every AI data center on the planet requires to run, delivered by the company that's been trusted with the world's most critical facilities for 100 years.
At 30 times forward earnings for a company with 33 consecutive dividend increases, a 15.8% ROIC, 12% expected annual EPS growth, and a new AI data center growth vector growing at over 80%. You are paying a discount to the historical multiple for a business that is meaningfully better than it was when that historical multiple was established.
Bull case target. If ECL re-rates to 35 times on $8.50 in FY 2026 EPS, fair value is approximately $298, 15% from here. If AI cooling revenues reach $1 billion by 2027 and pull FY 2027 EPS toward $10, the bull case at 35 times is $350, 36% upside from current levels.
Bear case, AI capex slows, institutional markets disappoint in H2, gross margin stalls at 44%, and the multiple compresses to 25 times. At 25 times FY 2026 EPS of $8.50, that's approximately $212. That's 18% downside. Real risk, but the asymmetry of the bull case at 36% upside makes the risk-reward skewed positive.
Why are we constructive on ECL here? Because Q1 results prove the AI data center revenue is real and growing at an exceptional rate. The gross margin trajectory is intact, the balance sheet is deleveraging, and you're buying the world's leading water treatment franchise at a 5-turn discount to historical multiple, precisely when it has the most powerful new growth catalyst in a century.
We'll leave you with Christoph Beck from the Q1 2026 earnings call. He said, the secular tailwinds in water technology, from AI data center cooling to global water scarcity to food safety, are converging in Ecolab's favor in ways we have not seen in our 100-year history. Our Q1 results are the early evidence of that inflection. That's the thesis. We'll see you next time on Charged Alpha.
This content is for informational and entertainment purposes only and does not constitute financial advice. All investments carry risk, including the potential loss of principal. Past performance is not indicative of future results. Always consult a licensed financial advisor before making investment decisions. Charged Alpha is not a registered investment advisor.
Ooh, we do! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.